Hey, welcome everybody to the 40 Finance channel. Last year was a record year for stock buybacks, and Q4 was actually the all-time record quarter for stock buybacks, at least in the S&P 500. Now, for me personally, I'm a fan of stock buybacks, assuming that a stock is on solid ground, they have EPS growth, they have revenue growth. And when you're in these times of uncertainty like we have right now here in 2022, stock buybacks can be an effective way to bring more value to shareholders. That being said, there is the flip side argument to this that basically says, a company should take their cash holdings and either reinvest it into the company, research and development, acquisitions, etc. And in this train of thought, some people view stock buybacks as sort of the easy way out and manipulation, if you will, of the stock price. Now for this video, we're going to take a look at who have been the biggest buyers, which sectors have been the biggest buyers, and what the return has been on this stock buyback investment across the S&P 500. Now, like I said, I am a fan of stock buybacks. It's hard to make a broad statement because each individual stock has different circumstances. But I would say, like generally speaking, across the S&P 500, those are the type of buyback operations that I generally agree with. But just to be fair, I do want to show you the other side of the argument. So Elizabeth Warren is a senator, and you get the key points here. She told CNBC that buybacks are market manipulation made to inflate executive pay. So the point with this statement is that there is a lot of senior executives who get paid based on the performance of their stock. So when they approve a stock buyback, they're essentially approving money to be spent in an area which directly impacts them. So as opposed to research and development, which may take 5 or 10 years to actually pay off, or perhaps an acquisition that can take a couple years before that would pay off, they're sort of choosing the easy road, if you will. Second point here, she said stock repurchases do nothing to improve the quality of a business or the goods and services it produces. And I can't really argue this point. If you take like Nike, for example, if they did buybacks, it doesn't really improve their shoe line or expand the options that customers have. But as a shareholder, the one thing it does do is improve EPS to a certain degree. And in times of lower growth, like we may see here in 2022, perhaps 2023, by taking shares out of the market, your earnings per share go up a little bit. Now keep in mind at an S&P 500 level, there's millions of shares in most cases out in the market. So while some of these big numbers get thrown around, let's just say like $100 million buyback, by the time you divide it by share price, it really doesn't make a huge dent, but in my opinion, it's at least progressing in the right direction, assuming that you do not have another enticing offer for the company to grow. Now, to further my point on stock buybacks in an uncertain market, we have this article from Wall Street Journal, March 15th. Companies are unveiling plans to repurchase their own shares at a record pace, lending support to the battered stock market. We have also had the prices of stocks come down dramatically in the wake of that uncertainty. So if you think about this from the executive's view or the CEO's view, if you've watched your stock price melt down 20+% like so many stocks have, you could make the argument, assuming you believe in your business for the long term, that your stock is on sale and that buying back shares in times of uncertainty makes a lot of sense, particularly when we're not sure how much it's going to cost, let's say, to develop new products, to get through shipping and logistics, high gas costs. All those things are in play here in the beginning of 2022. So I would make the argument myself to buy back shares as sort of the safe bet in a time when not very many things are stable. Here's the big news that's recently come out on buybacks, and it's basically a quarterly update, right? We just got through most of earnings season. Certainly, the large cap names have all reported mostly at this point. So the S&P has released their buyback report, and it also happens to be the one that includes all of 2021's share repurchases. But here's your subheadline that tells most of the tale. S&P 500 Q4 buybacks were $270 billion, up 15% from the record that was formerly set in Q3. Total 2021 buybacks were $881 billion, up almost 70% from 2020 and up 9.3% from the prior annual record that was set in 2018. Then down here in key takeaways, a couple things that I thought was interesting. Buybacks remain top heavy with the top 20 companies, again in the S&P 500, accounted for 52% of Q4 buybacks. That was actually down from Q3's 53% and down from the dominating 66% in Q4 of 2020, but up from pre-COVID historical average of 44%. So the top 20 companies are the ones doing most of the buying here. And, broadly speaking, I would say those are the companies that are in best position to pull this out without sacrificing future growth. All right, next call out here, roughly 15% of companies reduced share counts used for EPS by at least 4% year over year, up from Q3's 7.4% and Q2's 5%, but still significantly down from Q4 2019's 20% rate. So while we're setting some new records here, the percentage rate is actually lower than what we saw in 2019 before COVID. Total shareholder return of buybacks and dividends was a record $404 billion in Q4 of 2021, up 10% from Q3 and up 60% from Q4 of 2020. Total shareholder return for 2020 increased to a record $1.53 trillion. So if you were in the SPY or the S&P Top 100, based on what we know with the top-heavy approach to this, you received a record shareholder return for all the buyback activities. All right, in terms of the leaderboard, not a lot of surprises here. Apple spent $23.4 billion. Meta Platforms was next at $21 billion. Alphabet at $13.5 billion. Bank of America, $7.5 billion, and Microsoft, $7.4 billion. Now, it's interesting if you think about Q4 and what happened to the stock market in the first part of 2022, a lot of stocks, including the good ones, just say Microsoft, Google, came down in their price. In fact, we're still sort of waiting for a full-on rebound in the stock market. And if you look at Facebook, it gets an even little bit more dicey because their stock has fallen considerably, 20-30% since the start of the year. So some of the pundits would come in and say, wow, look at how much money Facebook wasted, right, buying their shares back in November or December when they could have just purchased them in January or February for X amount cheaper. And the numbers certainly don't lie in that case, but I will say if you've learned anything from this press release, it's safe to say more than likely Facebook probably is buying their shares here in Q1, and just like every investor is supposed to do, they're essentially dollar cost averaging, assuming they're making big purchases here in Q1 as well. All right, so from a percentage standpoint, this is the preliminary data for 2021 across the S&P 500. You had $800 billion in buybacks, and in the S&P 500, the dividend yield for 2021 was 1.27%. They're saying in this article that the buyback yield, so what investors gained from buybacks, was 2.18%. That brought your total yield for the S&P 500 on dividends and buybacks to 3.45%. Now, outside of the top 5 that we already looked at, if you're curious, which sectors are doing the most buybacks, I like this one because they do the sort of percentage view. Here's the total view from Q4 2021. But from a percentage view, consumer discretionary was 11%. I thought that was leader, but it's actually information technology, which is probably not a surprise. Almost 28% of all the dollar for dollar buybacks were in information technology. That was actually followed by financials, it looks like, at 19%, so the big banks. Then you had communication services, which also includes companies like Google. Interesting to note that the laggards, if you will, would have been the utilities companies and the real estate companies. Look like they are at the bottom of the barrel, followed by energy at 2.82%. Okay, let's see what share buybacks look like from a financials point of view for a company that might have an uncertain 2022. And I chose Home Depot. It's just my opinion. Home Depot is a phenomenal company, and I've almost bought this stock a couple times myself. But it's really hard to tell what's going to happen in 2022 with the threats of inflation. And then, of course, you have the home building market with those prices going up as well. So I'd say Home Depot, kind of a flip of a coin on which way their revenues are going to go, or certainly their profits. All right, so let's see how this stacks up here in Seeking Alpha. We've got Home Depot price today of $333. We're going to go to the Financials tab and down to Financial Statements. By the way, if you are interested in Seeking Alpha, I have a 50% off discount down in my description. That is my affiliate link. Check it out, potentially support the channel. Thanks to everybody who signed up. Hopefully you are enjoying it. For Home Depot, we want to come down here to supplemental items. And we're looking at EPS, and we're looking at average shares outstanding. Now, at the same time that they were improving earnings from 2017 through January of 2022, they also reduced the shares outstanding by 14%. So if you think about the earnings per share and how much that's increased from 2017, 6.47% up to 15.59, that's over 100% increase in earnings per share. Out of that 100+%, 14% can roughly be attributed to their buyback program over that same 5-year stretch. So this is a great example, and the graph shows it pretty well too. You're reading here from right to left. This is 2013. You can see EPS going up, and on the flip side, we have weighted average of shares outstanding going down. So this is a beautiful tandem of operations that you have here, right? Share count going down, EPS going up, and this is a perfect example of a company where I would say bring it on in terms of buybacks, assuming that there's just not some easy win out there that they haven't unlocked yet. So that's the catch. You can't shut down growth operations, but I know for a fact with Home Depot, they have some international expansion plans that are on a schedule. Okay, so that's a look at stock buybacks here through recent history, particularly in 2021. And if you go back to that original S&P press release, further on down, they're insinuating that 2022 will set even new records for stock buybacks. And what's interesting about that fact to me is depending on when these companies buy it, well, Q1 had a lot of stocks that were arguably on sale, particularly from some of the big buyers like Google and Facebook. Now, what does all this mean from an investor perspective? Should you only buy stocks that are doing buybacks? Should you pile in to stocks that have just announced buybacks? I don't think it really changes the game from that regard, where you're going to take money away from a stock that's not doing one to pour into a stock that is doing one. What I will say, though, is the more tailwinds you can give yourself when you're investing in individual stocks, the better. And right now, there's a lot of quality companies with increasing EPS that are also doing stock buybacks, and I think that's the key. So when you're coming through an index like the S&P 500, which generally has very stable companies that are unlikely to go bankrupt, certainly not in the top 100, they're unlikely to go bankrupt this year. Check into the stock buyback program, see what they're doing, and perhaps it will give you some more certainty heading into 2022, which could be a very uncertain year. All right, guys, let me know what you think about corporate stock buyback programs. Also, don't forget to check out that Seeking Alpha offer in the description. As always, please give the video a like, share with your friends. We'll see you on the next one.